usually a pretty reliable software business, given the strength of the labor market and the pretty integral role they play in a lot of company software and accounting. Shares have been kind of stuck, though, for about a year, but they're popping this afternoon. Workday just ramped up to $273 after closing at $255, so that's a pretty good rally. Go through some of the numbers here. For the trailing revenues, $2.21 billion. Street was looking for under 2.2 on average, so that is a beat. And the average estimate was looking for 2.18, so they hit 2.21. That's good. Bottom line earnings look more impressive. $1.92 adjusted EPS. Analysts expected $1.78. Pretty handsome beat there. Their subscription revenues for 2026 fiscal year at $8.8 billion. About where the Street was looking. Operating margin for fiscal 26, 28% versus 27.5%. Some nice beats there, Caroline, for a company that has been kind of underappreciated the past year.
Yeah, shares down about 16% over the past 1 year and pretty flat year to date. So the expectations weren't too high heading into this. You hit most of the main numbers there. I don't think you hit on Q4 subscription revenue, which also came in slightly better than what analysts were looking for if you look past the decimal. So subscription revenue of $2.04 billion was up almost 16% year over year. Analysts were looking for more like $2.02 billion. So that was also a slight beat there, but overall it certainly looks like a beat on both the top and bottom line and some upbeat outlook. You talked about I don't know if you said Q1 subscription revenue, the outlook is expected to be $2.05 billion too, so sequential growth there as well. And it looks like investors pretty happy with this one. Maybe it can finally enter positive territory for 2025.
Okay. You know, it hasn't really gone anywhere for about more than a year, actually. In fact, on the 52 weeks, it's down, which is somewhat surprising to me given the stability of the business when software generally has been up. KG, what happened here? Is it just not as big of a grower compared to some of the more nimble businesses out there in the software world, or what's going on? Does it deserve more love than it's gotten?
Well, it's one, there's a lot of competition when you're looking at the cloud space, because this is a cloud player basically now, right? And I think it's trying to get away from the human resource management aspect of their business, which is still a core portion of their business. But I think the rebranding effort has been a little bit more difficult than probably what they expected. And then they have been going through some restructuring. And so they do make a mention about the restructuring and how it impacted operating income for this quarter. But once again, we're kind of seeing the fruits of their labor when you're looking at margins expanding, especially when you're looking at their guidance moving forward. So maybe this is going to be the turnaround story here for now, but this stock really doesn't, it really does trade more like a utility stock. It's more range bound. And so we're at the lower end of a range around $255. And let's see if we're going to get a pop here and sustain a pop, and you would see a little bit of a area of resistance sitting at around $280. So we're $5 away from that right now. Any type of breakout above, let's say 285 is where you really get bulled up for this day.
Yeah, okay. Low double-digit sales growth, but still double digits nonetheless. So not as flashy as some of the competitors in cloud, but pretty stable. Intuit, another one this afternoon that generally is pretty stable, but the stock's come off quite hard in the last couple months. There's been rumors about how it might lose business if the government goes deeper into providing tax support. But it's still growing at almost double digits. Shares got hit in the couple weeks preceding this report. Their outlook for earnings is pretty weak. $19.16 to $19.36 for fiscal year adjusted EPS. Street was looking for $19.29. So the midpoint of there does come in below expectations. Probably not going to love that. But the next quarter revenue for the third quarter could be up to 13%, which is pretty solid. I mean, basically the same rate we were just looking at for Workday. Not quite as much, Caroline, but it's still double digits.
Yeah, I was taking a look at the estimates. The estimates were for less than 12% growth for the current quarter. So that actually comes in better than expected. For the trailing numbers, also adjusted EPS of $3.32, easily topped what analysts were looking for, the $2.58. Sales, meanwhile, were expected to increase about 13% to $3.81 billion. They came in at $4 billion, so that was also an easy beat there. And it looks like, this was one, again, lower bar. Shares down about 15% over the past 1 year. Shares down about 11% year to date. So certainly underperforming the market. And shares closed lower today heading into this report. And I'm seeing a bit of a bounce back here. So, I think 17% revenue growth and a little bit better of expected revenue outlook. You mentioned that the earnings might fail to impress, but we'll have to see what they have to say on the call here because it could go either way, I guess. Sort of a mixed report, if you will.
Okay. Credit Karma revenues 5 to 8%, pretty solid there. The consumer group overall 8%. They do have a pretty good suite of personal finance products that fit with today's kind of levered, indebted world, KG. So it seems the market, I don't know, I feel it's kind of been harsh, or is the idea that some of their business might have a shallow moat?
Well, some of their business also has a secular trend that's taking place as well. And they were also facing the risk, and maybe continuing, that the federal government was going to also provide tools to be able to file directly. And
is that why it's still been under pressure?
That has been a little bit of a concern, yeah.
Okay.
So I would say that is a concern. Credit Karma was a little bit weak over the last, at least for them to be able to integrate it and monetize it the way that they kind of expected. I think it took a little bit longer than what they expected, but they are seeing AI revenue growth because of the AI tools that they're integrating within their platform. So remember ServiceNow, when they started seeing some of that growth because of the new tools that they're integrating in, it started receiving a little bit of a premium. This is kind of the first report that they're actually acknowledging the fact that they are starting to see a turnaround when it comes to AI. And if it is going to be the case, yeah, it's probably going to eat into margins because you need to ramp up that infrastructure, a lot more spending in order to integrate. But over the long term, that could actually be a benefit. Now, anecdotally, I used TurboTax, a couple of weeks ago, and it's actually phenomenal. And the assistants that they do have that are AI related are
pretty good,
are really great. So it's a good experience. Yeah.
Yeah. It's definitely a beast. It's been around forever now, it seems, and has very good household recognizability. And that, I think, is a baseline to this company that it drives, I think, support in the stock. But to your point about what the government might be or might be not getting involved in, it was about a year which Intuit kind of went sideways. So there might be kind of lower bar here. I don't know, $571. It's not a huge rally, Caroline. It's kind of already given back a few dollars.
Yeah, I can't say that I've used TurboTax. My brother is a CPA, so he's my accountant.
Nice.
But I do use Credit Karma. They're not making any money off me, though, I don't think, because it's just every once in a while, to check to make sure that there's no credit cards that have been,
sure,
opened
and
in
they'll
my
definitely
name,
offer you a bunch more if you want.
Yeah, there's certainly a lot of advertisements there.
Yeah, I think they've got a pretty good business model.
Yeah, but I do miss their Mint platform because I did used to use that for personal finance. Granted, I was a free subscriber, but I do miss that, especially around tax time now when I'm trying to go through my write-offs and I don't have a program that's aggregating them for me.
Well, I know some products that you and services you might be more familiar with. Let's talk some Cava. Let's talk some Instacart. Which I think Cava's, maybe the more interesting one because it's been under pressure and it is going to stay under pressure in the aftermarket. It's trading at $70 right now. Instacart, though, Mabel Bear had that big run and then gave some back. I want to look at Cava real quick first, though. It looks like their earnings took a hit compared to a year ago. Hold on. Sorry. Earnings are continuing to expand from a year ago. They did about 66 cents. And a year ago, that was almost flat. So that's for the fourth quarter EPS. They're adjusted. Maybe ignore that number. Hold on. How about this? 5 cents versus the estimate 6.7 cents. Kind of getting some varying numbers. But their adjusted EBITDA, maybe a clearer one to go for, 25.1 million. Street was looking for 23.6. Comp sales, too, 21%, Caroline. That looks like a beat compared to the expectations.
Yeah, it was a bottom line miss with that 5 cents per share. I have an estimate of 6 cents per share, but making up for it on the top line, 227.4 million came in higher than the 225 million that Wall Street was looking for. And the expectation for same restaurant sales growth was 18.1%. So 21% certainly looks pretty good in terms of that. This is going to be an interesting one. I just am want to take a quick look at how the stock is reacting, it's lower. And, this is one that's gotten really hit hard. We talked about this earlier today. It was down about 12% year to date heading into the report, but down 26% just this month alone. So, we've seen this really impressive run up over the past year. And so I thought maybe, the bar would be lowered here, but certainly looks like they're getting punished, maybe for that bottom line miss. In terms of the outlook here, same restaurant sales growth of 6 to 8%. Versus estimates of 8.2%. So I'm guessing that it's the outlook that's really what's weighing on shares versus the trailing number, the bottom line miss. And then Q4 revenue. No, actually, that's the trailing number. So it looks like the same restaurant sales outlook is maybe what's really the bad news here. I mean, still impressive growth, 6 to 8%. You can't balk at that. But I think that the fact that Wall Street was looking for a little bit more, it's a disappointment.
Yeah, and the fact that they do get the high end at 8%, if they hit the high end, then they're fine compared to the estimate. But obviously, the implication of the 7% in between is a miss. I mean, I don't know. There's comp sales of 7% on average, pretty good by food standards, but maybe not if you're trading at 200 times earnings, Kevin.
Yeah, this is where it comes into a little bit of a rock and a hard place when you're looking at year-over-year comps, right? Because we've been used to seeing 20%, year over year, and now you're looking at 6 to 8%. They could also be guiding a little bit conservatively as well. Who knows what's actually happening? I mean, if we look at Chipotle, it kind of had a similar type of reaction when it came to their outlook for the market, and maybe Cava's taking the same type of approach here. But once again, they have some really good bright spots here, and on the conference call, they might be able to explain the reasons to maybe a little bit more of a conservative guide, and it may not all be bad. It might just be uncertainty in the market in general.
Okay. Yeah, it's certainly a pretty impressive growth business right now for its industry, but also a very expensive stock. Thank you guys very much. I got one more to handle for us here, and I'm taking it because I like to say the name Maple Bear. Instacart owner, Maple Bear, just love that name. It sounds like a Yogi Bear from Canada, like a cartoon or something. $77.5 million in orders, revenue $883 million. So $77.5 million orders off of Maple Bear Instacart, EPS of 53 cents, and the gross transaction volume outlook of 9 billion to 9.15 billion. That's for the next quarter. Seems like a decent number. Shares have been under some pressure the last week, but are going to see a little bit. They were at 43. They're at 44.5 right now, so they're getting hit down about $5. That revenue outlook might be a little bit short versus some of the expectations. So market punishing them a little here in the afternoon. We're going to talk some more earnings, though, with First Solar. George Tillis coming